actual financial cost of COVID-19 is something the Indian government would rather not acknowledge, as it would be a gigantic task to bear. That explains why the central bank has allowed a one-time restructuring of corporate and personal loans that have been under stress since the country went into lockdown. The RBI's decision to allow one-time restructuring of corporate and personal loan under stress highlights the deep financial crisis caused existing in the Indian economy due to COVID-19. There is a sense of denial among policymakers, even as efforts are made to sweep the true financial impact of the pandemic under the carpet. The nationwide lockdown imposed from March has now given way to more localized containment. But with India becoming only the third country after US and Brazil to cross the 2 million infections mark, it will be months before the economy can reach pre-COVID levels, let alone achieve significant GDP growth. And it's not that the economy was on a bullish run before the pandemic hit the country. Consumers were reeling under huge debts, companies were steadily deleveraging, and exports were poor. To add to this, the real estate sector was down. Financial borrowing lacked confidence, and public activities were disrupted by lack of resources. Yet, just to return to this slow-paced economy, India will at least have to generate the capital lost to the pandemic. The ability of assets to earn returns across industries in India has been impaired. The money shortfall is large, and filling this hole will be a major challenge. Also, the government is not in a position for large-scale socialization of private losses. Very few large Indian business groups have disposable funds, and those that do would rather preserve it for now. Global specialists may be willing to look deeper into the distressed assets, but India's bankruptcy court is shut to new cases for a year. Without the pressure of insolvency, only the property and infrastructure company may want to sell out to private equity and pension funds. These companies were under financial stress even in the pre-pandemic era. Many small-scale borrowers are currently at crossroads of a central bank freeze on loan servicing. They will welcome the chance to end their dilemma with a one-time loan structuring to be implemented by March next year. The lenders who aren't even accounting for their advances will now use tools like debt equity swaps and 2-year extension of repayment periods to keep avoiding significant loan loss provisions. Most of these hurried recasts are sure to follow standard templates. Hopefully, by the time the stipulation is in place, the economy will have stopped shrinking. This way, the banks will have some operating profit to absorb losses. If they were to come clean now, they would have to find much more than the record $10 billion plus fundraising currently in the work. Whether the loan relief succeeds or fails, one thing is certain, that India's $1.4 trillion credit machine will be stalled until next March as restructuring eats up banks' bandwidth and the scope of new credit creation goes down. Shadow banks will be the biggest losers. They will restructure their borrowers' loans, but their own ability to bank won't get the same treatment. Only a few years ago, non-banking financiers were meeting 30% of the economy's new credit demand. But after a few things went wrong, the authorities prefer that lending is performed by deposit-taking banks. We can surely expect the beaten-down non-bank financiers to become the next acquisition targets. American buyouts firms may be willing to do so if they get a good price. This can surely bring transparency to Indian financial systems. The financial vacuum created by the ongoing pandemic has only aggravated the crisis being faced by the country. While demands for funds will continue to remain high across sectors, the announcement on loan restructuring is expected to provide short-term relief to stressed assets. What, according to you, are the financial instruments which can be leveraged at this time to reinstate investor confidence in the system? How can the public and private sector together revive the economy with the available resources?